What if the mansion everyone pointed to as proof of security was actually the loudest warning sign no one wanted to hear? Pause for a second. Let that sink in. Because for years, this house wasn't just a house. It was a symbol, a flex, a statement to critics, skeptics, palace insiders, Hollywood gatekeepers, and the global audience watching every move. A hilltop refuge in Montecito that whispered independence, wealth, safety, and control. Or at least, that's what it was supposed to whisper. Before we continue, please hit the like button, subscribe to the channel, and turn on the notification bell for updates. So why is it suddenly for sale? And not just for sale quietly, not off-market, not passed discreetly between billionaires over dinner, but listed, public, loud, with a price tag that makes people stop scrolling. And even more unsettling, why is the name tied to it not who you'd expect? Because this isn't just about a property. This isn't even just about money. This is about timing, pressure, silence, and the uncomfortable moment when narratives collide with math. Let me ask you something directly. When a billionaire like Tyler Perry makes a move, do you assume it's emotional or strategic? And when a couple who traded royal life for freedom suddenly can't sustain the lifestyle that freedom requires, do you call that bad luck or bad planning? Now, before anyone jumps to conclusions, slow down. This story isn't about gossip. It's about patterns. It's about signals. It's about what happens when public stories and private realities drift too far apart to coexist. Because houses don't just go on the market for no reason. Especially not in Montecito. Especially not now. Montecito isn't just a zip code. It's a message. A carefully curated enclave where wealth isn't loud, but it is deliberate. Where neighbors don't ask questions, but they notice everything. Where listings are read like medical charts by people who know exactly what to look for. So when a $14 million property tied to Tyler Perry suddenly appears, that's not background noise. That's a tremor. And here's where it gets complicated. This mansion has been linked, repeatedly, to Prince Harry and Meghan Markle as a symbol of refuge, generosity, and support during a turbulent exit from royal life. A place framed as temporary at first, then quietly treated as something more permanent. A soft landing. But temporary arrangements have a way of overstaying their welcome when expectations don't meet reality. Let's rewind. When Harry and Meghan left the UK, the world was told a simple story. They wanted privacy. They wanted independence. They wanted to build something on their own terms. But independence has a price. And privacy, especially in California, comes with a monthly bill that doesn't care who you are. Security, staff, insurance, legal teams, advisors, image management, travel, property maintenance, taxes, and that's before you even get to the house itself. So the real question becomes this. What happens when the income everyone assumed would flow doesn't arrive the way it was projected? What happens when contracts don't scale? When deals underperform? When legal costs balloon quietly in the background? And what happens when a friend with deep pockets starts asking a question that changes everything? How long is this supposed to last? Because generosity has limits, even among billionaires, especially when reputational exposure enters the chat. Now, let's be very clear. There has been no public announcement framing this as a crisis. No press release screaming financial trouble. No admission of strain. And that's exactly why this listing matters. Because the richest stories don't announce themselves. They leak. They surface through paperwork, through timelines, through decisions that don't quite align with the public narrative. Think about it. If everything was stable, if everything was under control, if income streams were covering expenses comfortably, why would this house need to be sold now? Why not wait? Why not quietly refinance? Why not pass the property to another trusted buyer behind closed doors? Why the open market? Why the urgency implied by the pricing? And why the silence from Tyler Perry himself? Silence, by the way, is never accidental at this level. Silence is a choice. It's a strategy. And sometimes it's an exit. Let's talk about that for a moment. Tyler Perry isn't known for impulsive decisions. His empire is built on control, timing, and ownership. He understands optics better than most people in Hollywood. He knows when to speak, when to move, and when to step away without explanation. So when his name appears in connection with a listing that immediately triggers speculation, and he says nothing, that silence speaks volumes. Because if this were a simple investment flip, the narrative would be easy. If this were just market timing, someone would float that explanation. But no one has. Instead, there's a vacuum. And vacuums get filled by whispers, by questions, by people connecting dots that were never meant to be connected publicly. Here's the uncomfortable truth. Montecito is full of people who understand money. Real money. They know the difference between wealth and liquidity, between assets and cash flow, between borrowed stability and sustainable independence. And those people don't panic over headlines. They react to signals. A listing is a signal. A price is a signal. Timing is a signal. And when multiple signals point in the same direction, people start asking questions no PR team can fully control. Now, I want you to ask yourself something honestly. If you were Tyler Perry, and a situation that began as generosity started to carry reputational, financial, or legal risk, what would you do? Would you fight publicly? Or would you quietly remove yourself from the equation? Would you explain? Or would you let the asset speak for itself? Because selling the house doesn't accuse anyone of anything. It doesn't assign blame. It doesn't create a scandal. It simply closes a door. And sometimes, closing a door is the cleanest way to end a chapter that's become too complicated to continue. But here's where the story gets even more uncomfortable. A house like this doesn't exist in isolation. It's connected to ongoing expenses, to expectations, to narratives about success, stability, and thriving. So when that house is suddenly no longer part of the picture, it forces a reckoning. What replaces it? What fills the gap? And what does that say about the financial reality behind the scenes? Because image is expensive, and maintaining the image of having made it in Hollywood while simultaneously fighting legal battles, brand fatigue, and shifting public sentiment is a balancing act that gets harder every year, especially when deals don't renew the way people expected, especially when media contracts don't stretch forever, especially when the audience starts to move on. And that's the part no one wants to talk about, because it's easier to focus on personalities than on spreadsheets. But spreadsheets don't lie. They don't care about titles. They don't care about intentions. They don't care about trauma narratives or reinvention arcs. They care about numbers. And when numbers stop working, something has to give. Sometimes it's pride. Sometimes it's lifestyle. And sometimes it's the house everyone thought was untouchable. So here we are. A $14 million mansion. Montecito. Tyler Perry's name attached. Prince Harry and Meghan Markle's future suddenly under quiet scrutiny. No official statements. No denials. Just movement. And movement, in this world, is never random. Now ask yourself this. What happens next? Because selling the house doesn't solve everything. It triggers consequences, questions, adjustments. And once that first domino falls, others tend to wobble. But what came next would change everything, and no one saw it coming. What if the house everyone assumed was a short-term solution quietly became the long-term problem? Because that's where this story actually begins. Not with a listing, not with a price tag, but with an assumption that hardened into expectation. Temporary. That was the word used early on. Temporary stay, temporary refuge, temporary bridge between one life and the next. A place to exhale while plans came together, while contracts were signed, while the future solidified. But here's the thing about temporary arrangements. They only work when the next step arrives on schedule. So let me ask you this right up front. At what point does temporary turn into permanent without anyone ever announcing it? Because no one ever stood at a podium and said, "This is it. This is home." It just happened. The routines formed. Security settled in. Staff learned the rhythms. Neighbors adjusted. Montecito, quietly, absorbed another high-profile presence into its ecosystem. And Montecito never forgets who's there. This town operates on an unspoken contract. If you're here, you belong. If you belong, you can afford it. And if you can afford it, you don't draw attention to the mechanics of how. That's why this particular mansion mattered so much. It wasn't just beautiful. It was positioned, elevated, private, expensive in ways that go far beyond the purchase price. Every square foot came with a cost multiplier. Every added layer of security doubled something else. Every expectation of privacy required another buffer, another service, another bill. And yet, from the outside, it looked effortless. That's the illusion Montecito does best. Now, think back to the early days. The narrative was momentum, opportunity, A clean break. There were deals in the headlines, projects teased, partnerships implied. The assumption baked into all of it was simple: the money will come. Not might come, will come. Because when you're trading on global fame, sympathy, curiosity, and access, the belief is that revenue is inevitable. That time is on your side. But time is only your ally if your burn rate respects reality. And here's where the contradiction creeps in. A house like this doesn't just sit there passively. It consumes. It demands upkeep. It demands presence. It demands justification. The longer it stays in use, the more it stops being a placeholder and starts being a commitment. So the question becomes, who was actually committed here? Was it the people living in it, or the person providing it? Because generosity, when stretched too long, starts to morph into something else. Obligation, expectation, exposure. And exposure is where things get uncomfortable. Let's talk about ownership for a moment. Not legal ownership, psychological ownership. When you live somewhere long enough, when your routines are built around it, when your identity is visually tied to it through paparazzi shots and media references, that place stops feeling borrowed. It starts to feel earned, even if the paperwork says otherwise. And that's dangerous territory. Because when perception shifts faster than reality, the correction is always painful. Now imagine being the person on the other side of that equation. The owner, the provider, the one who opened the door in a moment of goodwill and support. At first, it feels good. It aligns with your values. It reinforces your public image as someone who helps, who shows up, who does the right thing. But goodwill has a shelf life when circumstances change. And circumstances always change. What happens when the temporary stay stretches past the originally imagined timeline? What happens when the next step keeps getting delayed? What happens when the narrative of just until things stabilize starts to sound familiar? Because behind closed doors, timelines matter. Not publicly, privately. Bills don't care about symbolism. Accountants don't care about optics. Advisors don't care about headlines. They care about exposure. And exposure grows with time. Now here's a detail most people overlook. Montecito isn't forgiving when it comes to ambiguity. If you're there, you're either rooted or you're passing through. And people can tell the difference. Passing through looks light, minimal footprint, low friction. Rooted looks heavy, embedded, expensive. And by all accounts, this arrangement had shifted into the second category. That shift doesn't require bad intentions. It doesn't require deception. It just requires optimism outpacing reality. But optimism doesn't pay property taxes. So let's zoom out. At some point, someone had to ask the uncomfortable question. Not in public, not angrily, but practically. How long does this continue? And more importantly, what's the exit? Because every arrangement like this needs one. An end date, a transition, a plan that protects everyone involved. Without that, silence creeps in. Silence in conversations. Silence in expectations. Silence in assumptions no one wants to challenge. And silence is where misunderstandings grow teeth. Think about the power dynamic for a moment. When you're the guest, you don't want to push. You don't want to acknowledge strain. You don't want to admit that things aren't landing the way you hoped. When you're the host, you don't want to seem cold. You don't want to be the one who brings up money. You don't want to risk being painted as unsupportive. So both sides wait. And waiting is expensive. Because while people wait, costs accumulate. Security remains. Staff remains. Maintenance remains. Insurance remains. The meter never stops running. Now ask yourself something honestly. If this arrangement truly felt temporary, why did it start to look so settled? Why did the optics shift from staying to living? Why did the language around it soften into permanence without anyone officially declaring it so? Because once the idea of permanence enters the room, expectations change. And expectations are dangerous when they're not shared equally. This is where the house itself becomes a character in the story. It stops being a backdrop and starts being leverage. Leverage over perception. Leverage over narrative. Leverage over responsibility. And leverage cuts both ways. On one hand, it offers safety, stability, continuity. On the other, it creates dependency. And dependency, no matter how unintentional, is something successful people are trained to avoid. So imagine the internal calculus. Not emotional, strategic. Is this still a favor, or has it become a liability? Is this still support, or is it now exposure? Is this still manageable, Or is it quietly complicating everything else? Those questions don't get answered overnight. They build, and they tend to surface through action, not words. Which brings us back to the listing. Because listing a house like this isn't just a real estate decision. It's a boundary, a reset, a message that doesn't need a press conference. It says, this chapter is ending. But endings are rarely clean when expectations were never fully aligned. Now, here's where the story tightens. Once the possibility of an exit enters the picture, everything else starts to wobble. Plans that assumed continuity suddenly need revision. Narratives built on stability start to sound hollow. And the people involved have to confront something deeply uncomfortable. What if the safety net disappears before the next platform is fully built? What if the bridge was longer than expected, and now it's being dismantled? That's when urgency creeps in. Not visible panic. Controlled urgency. Strategic urgency. Calls get made. Advisors looped in. Options weighed. Refinance. Relocate. Downsize. Reframe the story. Every option comes with trade-offs. Financial. Reputational. Psychological. And the hardest part? None of those options preserve the original illusion. Because once a situation moves, it admits that something has changed. And change is the one thing carefully curated narratives struggle to absorb. So here we are. A mansion that was never supposed to be permanent. A stay that stretched longer than expected. A silence that grew heavier by the month. And then, quietly, the decision. Put it on the market. Not as a scandal. Not as a confrontation. But as a conclusion. The problem is, conclusions create ripple effects. Because when a house like this goes up for sale, it forces everyone involved to answer a question they may have avoided for too long. What comes next? And more importantly, who is actually prepared for it? Because the moment the listing went live, it didn't just signal an ending. It triggered a countdown. And what happened next would expose pressures no one was ready to admit. What if the most important person in this story is the one refusing to explain himself? Because here's the uncomfortable truth most people dance around. This situation doesn't make sense unless you stop looking at it through emotion and start looking at it through leverage. Let me put it to you plainly. When a man with Tyler Perry's resources, influence, and experience makes a move, it's never casual. It's never accidental. And it's almost never about money in the way most people understand money. So why is his name even here? Why is a filmmaker, studio owner, and billionaire power broker suddenly tied to a real estate story that's making people whisper behind manicured hedges in Montecito? That's the question nobody asked out loud at first. And that silence was intentional. Because asking that question forces you to confront something far more unsettling than a house sale. It forces you to ask who was really in control of this situation the entire time, and whether that control ever quietly shifted. Let's rewind again. But this time from his perspective. Tyler Perry didn't step into this moment as a landlord. He stepped into it as a stabilizer. At a time when chaos was loud, when exits were messy, when bridges were burning publicly, he offered something invaluable. Structure. Not just a place to stay. A buffer. A pause button. A way to regroup away from immediate scrutiny. That kind of intervention isn't impulsive. It's deliberate. And it usually comes with an internal understanding, even if it's never written down. This is temporary. This is transitional. This is support, not substitution. But here's where reality intrudes. Support arrangements depend on progress. They assume forward motion. They assume that the people being supported are actively building the next phase. And when that next phase takes longer than expected, patience gets tested. Now, ask yourself this. At what point does generosity start to feel like exposure? Because generosity isn't free. Not when it involves high-value assets. Not when it places someone else's lifestyle choices under your umbrella. And certainly not when your own reputation for discipline, control, and independence is part of your brand. Tyler Perry didn't build his empire by ignoring risk. He built it by managing it relentlessly. So let's talk about risk. There's financial risk. That's obvious. Carrying costs, maintenance, insurance, taxes, all manageable on paper. But there's reputational risk, and that's harder to quantify. When your name becomes associated with someone else's instability, delays, or controversies, even indirectly, the calculus changes. Suddenly, what was framed as kindness can be reframed by others as enablement. And no one at that level wants to be cast in that role. Now here's where the contradiction starts to bite. Publicly, Tyler Perry is generous, loyal, values-driven. Privately, he is disciplined, protective, and intensely strategic. Those two sides don't conflict, but they do require balance. And balance becomes difficult when silence stretches too long, because silence creates space for assumptions. A house like this doesn't just cost money when you buy it or rent it. It costs money every single day it exists around you. Security alone isn't optional here. Not at that level. Not with that profile. And security doesn't mean one or two guards. It means rotating shifts. It means technology upgrades. It means armored transport considerations. It means redundancy. Redundancy is expensive. Then there's staffing. Full-time staff. On-call staff. Specialists. People whose discretion costs more than their labor. People who expect stability, not temporary. Because once you start operating like a permanent resident, everyone around you adjusts their expectations accordingly. Then there's insurance. Not standard insurance. Custom insurance. High-risk profiles. Policies that quietly balloon when circumstances change. And that's before you even touch legal costs. Because here's the part people rarely talk about. Living at this level creates legal exposure constantly. Contracts. NDAs. Employment agreements. Advisory retainers. Quiet settlements. Ongoing consultations. Each one small on its own. Crushing in aggregate. Now, add property taxes. Montecito property taxes are not theoretical. They're relentless. They don't negotiate. They don't pause because your year didn't go as planned. They arrive on time. Every time. So here's the uncomfortable math. Even if you don't own the house outright, the lifestyle attached to it functions as if you do. And that's where the pressure cooker starts to heat up. Because at first, optimism cushions the impact. There's always something coming. A deal. A renewal. A new project. A rebrand moment. But optimism has a shelf life. And Montecito burns through optimism faster than almost anywhere else. Why? Because nothing here scales down gracefully. You can't quietly reduce security without signaling vulnerability. You can't cut staff without whispers spreading. You can't downgrade lifestyle without the narrative shifting. Every adjustment is visible. And visibility is dangerous when your image is part of your currency. So instead of scaling down, people stretch. They delay. They juggle. They assume the next check will arrive in time. And when it doesn't, things start to get tense. This is where debt enters the conversation in a way most people misunderstand. Debt at this level isn't reckless spending. It's bridging. It's smoothing. It's covering gaps while waiting for revenue to catch up. But bridging only works when the bridge leads somewhere. What happens when the other side never quite materializes? That's when pressure turns into compression. And compression creates mistakes. Now picture this scenario. The bills keep coming. The lifestyle remains fixed. The narrative insists on stability. But behind the scenes, advisors start using words like exposure and burn rate. Those are not words you want to hear when your public image depends on calm confidence. So what do people do? They hold on. They convince themselves that downsizing would look worse than stretching. That admitting strain would be more damaging than absorbing it quietly. And Montecito feeds that instinct. Because this place punishes visible retreat. It rewards composure, even when that composure is financially irrational. Now here's the twist most people miss. Montecito doesn't just pressure the people living there. It pressures the people associated with them. Neighbors notice patterns. Staff notice changes. Service providers notice delays. And those observations don't stay isolated. They circulate. Not maliciously. Casually. Over lunches. Over referrals. Over quiet check-ins. Are they staying long-term? Did you hear they're adjusting security? I heard the timeline changed. This is how narratives form without a single headline. And once those narratives exist, the pressure intensifies. Because now you're not just managing finances. You're managing perception. And perception is expensive. This is where the house itself becomes a trap. Leaving looks like failure. Staying looks like confidence. But staying costs more every month. So you stay until you can't. And when you can't, the exit has to be decisive. Controlled. Framed as intentional. Which brings us back to the listing. Because the listing wasn't just a sale. It was a release valve. A way to stop the pressure from escalating further. But here's the part that makes this situation uniquely volatile. The people living inside that pressure cooker didn't just have to manage Montecito. They had to manage expectations set years earlier. Expectations of success. Expectations of independence. Expectations of financial autonomy. And when expectations are high, the margin for error shrinks. Suddenly, every adjustment feels like a contradiction. Every move invites interpretation. Why move now? Why this house? Why this price? Those questions don't arise in a vacuum. They arise because something underneath them shifted. Now imagine the moment when it became clear that Montecito was no longer sustainable in its current form. Not emotionally, financially. That realization doesn't come with fireworks. It comes with spreadsheets, with projections that no longer close, with expenses that don't flex, with advisors who stop sugarcoating. And once that realization lands, it changes everything. Because now the goal isn't thriving, it's containment. How do you stop the bleed without triggering a narrative collapse? How do you reduce exposure without admitting strain? How do you leave without looking like you're being pushed? Those are the questions that keep people awake at night. And Montecito has a way of making those nights very long. Now let's talk about timing again. Why did this pressure reach its peak now? Because time compounds costs. And it also compounds scrutiny. The longer you stay in a place like this, the more permanent your presence appears. The more permanent it appears, the harder it is to justify leaving without explanation. That's why exits tend to happen suddenly. From the outside, it looks abrupt. From the inside, it feels overdue. And once the exit decision is made, everything accelerates. The house goes on the market. The story shifts. The speculation begins. But here's the catch. Selling the house doesn't erase the financial reality that led to the decision. It exposes it. Because once you remove Montecito from the equation, people start asking what replaces it. What lifestyle adjustment follows? What geographic shift comes next? What does this mean for long-term plans? Those questions don't have easy answers. And that's why this chapter matters. Because Montecito wasn't just a setting. It was a stress test. And the results of that test are now impossible to ignore. The pressure cooker did what pressure cookers do. It forced a release. But releases don't happen without consequences. Because the moment the house went up for sale, the pressure didn't disappear. It migrated. And where it migrated next is where this story gets even more complicated. Because once the lifestyle equation started collapsing, attention shifted to something far more dangerous. The numbers. And the numbers are about to take center stage. What if the most dangerous word in this entire story isn't betrayal or failure, but obligation? Because that's the word everything quietly circles around. Debt. Not the cartoon version people imagine. Not reckless spending or collapse overnight. But layered, structured, respectable debt. The kind that looks manageable right up until it isn't. Let me ask you something directly. Have you ever noticed how people at the highest levels rarely say the word debt out loud? They use substitutes. Exposure. Commitments. Carry costs. Deferred obligations. Softer language. Cleaner language. But the math underneath doesn't care what you call it. And that's where this chapter begins. Because once the Montecito pressure cooker started to hiss, attention shifted from optics to arithmetic. From image to infrastructure. And infrastructure is where the story gets uncomfortable. Here's the first contradiction most people miss. Publicly, the narrative was success. New deals. New platforms. Global relevance. Reinvention. Privately, the financial model depended on timing. Timing of contracts. Timing of payments. Timing of renewals. And timing is fragile when your expenses are fixed, but your income is variable. This is especially true for high-profile figures like Prince Harry and Meghan Markle, whose earning power is front-loaded. Big headlines early, big checks early, then diminishing returns if momentum slows. That's not a judgment. It's how the entertainment economy works. The first deal is the largest. The second is scrutinized. The third is conditional. And every deal after that depends on performance, audience appetite, and public sentiment. Now put that income pattern next to a lifestyle that assumes permanence. Security that doesn't scale down easily. Legal teams that don't pause. Staff that expect continuity. Property costs that don't negotiate. That's when bridging becomes tempting. Bridging isn't failure. It's strategy. You bridge gaps while waiting for expected income. You smooth out volatility. You assume the future will validate the present. But bridges are only safe if the destination exists. And here's where the debt question becomes unavoidable. At what point does bridging turn into dependence? Because once you rely on future income to justify present obligations, you're betting on a narrative continuing to perform. And narratives, unlike contracts, are volatile. Audience fatigue sets in. Platforms pivot. Executives change. Cultural focus shifts. And suddenly, the future you budgeted for doesn't arrive on schedule. That's when obligations start stacking. Not catastrophically. Gradually. A deferred payment here. A restructured obligation there. A quiet extension. A renegotiation framed as flexibility. Each one reasonable on its own. Together? Heavy. Now add something else to the mix. Legal exposure. High-profile lives generate legal gravity. Complaints. Threats. Settlements. Advisories. Preemptive consultations. These aren't scandals. They're maintenance. But maintenance at this level is expensive, and it doesn't show up in glossy profiles or celebratory interviews. It shows up in line items. Now imagine the moment advisors start running projections that assume less optimism. What if the next deal isn't as large? What if it's delayed? What if it underperforms? What if public sentiment doesn't convert to long-term revenue the way it once did? Those questions don't require panic to be dangerous. They only require honesty. And honesty is the thing most people avoid until it's unavoidable. This is where the phrase "can't pay debt" needs to be understood correctly. It doesn't mean $0. It doesn't mean bankruptcy. It means stress. It means obligations approaching deadlines without clear coverage. It means choices narrowing. Do you prioritize security or optics? Do you maintain staff or scale back quietly? Do you hold the house or release it? Each choice carries consequences. And that's where the Tyler Perry connection quietly re-enters the frame. Because when someone with Tyler Perry's discipline and financial clarity sees obligations accumulating without a clear exit timeline, the response isn't emotional. It's procedural. He doesn't wait for crisis. He avoids it. And that's why the house sale matters in this chapter more than any rumor. Because selling the house isn't about profit. It's about removing a fixed variable from an increasingly unstable equation. Think about it. Once the property is gone, a massive chunk of obligation disappears overnight. Not just the house, the security footprint tied to it, the staff structure built around it, the insurance policies, the tax exposure. That's not a coincidence. That's relief. But relief for one party creates urgency for another. Because once that safety valve opens, the people who relied on that stability are forced to confront their own numbers without cushioning. And that's when debt stops being abstract. Now ask yourself this. If everything was truly under control, would this step be necessary? If income was comfortably exceeding obligations, would anyone rush to dismantle a setup that offered privacy, prestige, and stability? Of course not. People don't give up leverage when they don't have to, which means the pressure wasn't hypothetical. It was present and growing. Now here's another layer people avoid. Debt at this level isn't just financial. It's psychological. Living with mounting obligations while projecting confidence is exhausting. It forces constant calculation, constant vigilance. Every public appearance becomes a performance of stability. Every decision is weighed against cost and perception. Every delay creates anxiety, and anxiety changes behavior. It makes people defensive. It makes them reactive. It makes them cling to narratives longer than they should, which is why exits often look sudden to outsiders. But they're anything but sudden to the people living inside them. By the time the house was listed, this decision had been incubating for months. Quiet conversations, advisor warnings, internal debates, and at some point, someone had to say the sentence no one wanted to hear. This isn't sustainable. That sentence doesn't accuse anyone of failure. It just acknowledges reality. And once reality is acknowledged, the next step is inevitable. Cut exposure. Reduce obligations. Simplify the equation. But here's where the story tightens again. Cutting exposure at this level isn't neutral. It sends signals. Signals to Hollywood. Signals to potential partners. Signals to critics waiting for cracks. And that's the cruel irony. The very move designed to stabilize finances can destabilize perception, which means the people involved are trapped between two risks. Continue as is and bleed quietly, or change course and invite scrutiny. Neither option is painless. So what do people choose? They choose the option that preserves long-term survival. And survival isn't glamorous. Survival looks like downsizing. It looks like recalibration. It looks like letting go of symbols that no longer serve the math. That's what the house became. A symbol that stopped aligning with reality. And when symbols and reality diverge too far, reality always wins. Now consider this. Once the house is gone, the debt conversation doesn't end. It intensifies. Because now everyone is watching what comes next. Where do they go? How do they adjust? What lifestyle replaces the old one? And those answers will reveal far more than any headline ever could. Because debt isn't exposed by words. It's exposed by movement. And movement is coming. Because selling one house doesn't erase obligations elsewhere. It just forces prioritization. And prioritization, when observed closely, tells the truth. So here we are. The Montecito chapter closing. The Tyler Perry buffer removed. The financial math stepping into the spotlight. And the question nobody wants to ask out loud is now impossible to ignore. What happens when the obligations outpace the narrative? Because that's the moment everything changes. And in the next chapter, we're going to see how the people around them started reacting when that moment became impossible to deny. Because when money tightens, friendships get tested. And not everyone stays quiet. What if the first thing to crack under financial pressure isn't money, but loyalty? Because that's where this story turns personal. Up until now, everything has been abstract. Houses, numbers, advisors, decisions made behind closed doors. But once financial pressure reaches a certain point, it stops living on spreadsheets and starts showing up in relationships. And Hollywood relationships are a special kind of fragile. Let me ask you something honestly. How many friendships in this town are built on permanence? And how many are built on momentum? Because Hollywood loves winners. It loves trajectory. It loves the illusion that success is self-sustaining. But when momentum slows, the room changes. Suddenly calls take longer to return. Meetings get rescheduled. Invitations thin out. The warmth cools. Not because anyone is cruel, but because proximity to uncertainty is uncomfortable. And uncertainty is contagious. Here's the thing people don't like admitting. Hollywood friendships are often situational. They thrive when everyone involved is ascending. When deals are closing, when headlines are favorable, when relevance feels secure. But when one party starts recalibrating, downsizing, or quietly adjusting expectations, the energy shifts. People feel it. And that's exactly what started happening here. At first, nothing dramatic. Just subtle changes. Fewer casual check-ins. More conversations routed through assistants. A sense that everyone was busy, all at once. Now imagine being on the inside of that shift. You're already managing pressure, already watching numbers, already making compromises you never planned to make. And now the social insulation you once relied on begins to thin. That's destabilizing. Because in Hollywood, social capital often feels as valuable as cash. It opens doors. It buys patience. It creates opportunities. But social capital is conditional. It depends on perception. And perception doesn't update kindly when financial reality intrudes. Here's where the contradiction becomes impossible to ignore. Publicly, the message remained confidence, forward motion, purpose. Privately, the conversations were changing tone. Instead of expansion, people talked about consolidation. Instead of what's next, the question became what's necessary. Instead of growth, it became survival. And survival conversations don't inspire the same enthusiasm. Now let's talk about favors. Hollywood runs on them. Introductions, referrals, soft commitments, bridge opportunities. But favors, like generosity, have limits. They assume reciprocity. They assume momentum. When momentum stalls, favors dry up. Not out of spite, out of caution, because nobody wants to be the one still attached when the narrative turns. Now imagine the impact of the house listing on this ecosystem. The listing wasn't just a financial move. It was a signal. It told people that something was changing. And Hollywood is hyper-attuned to change. The moment that signal went public, it reframed everything. Suddenly, previous assumptions were questioned. Are they staying here long-term? Are they downsizing? Are things not working the way we thought? And once those questions enter the room, they don't leave quietly. This is where the phrase Hollywood friends versus financial reality stops being theoretical. Because financial reality has a way of forcing clarity. Who's offering support? Who's offering distance? Who's waiting to see which way the wind blows? And that sorting process is brutal. People who once felt close start creating space. Not openly, politely, professionally. And that polite distance can feel colder than outright rejection. Now let's be clear. This isn't about abandonment. It's about alignment. Hollywood aligns with trajectories, not intentions. So when the trajectory becomes uncertain, alignment weakens. That's what was happening here. And it was happening quietly. The problem is, quiet shifts still hurt, especially when you're already under strain. Because when you're managing financial pressure, you rely more heavily on emotional stability. And when emotional stability erodes at the same time, it creates a perfect storm. Now add one more layer. Reputation. Hollywood doesn't just watch. Because in the next chapter, we're going to see how the optics war began, how public narratives started fighting private reality, and how spin can only hold for so long before facts start pushing back. Because once perception and reality collide, one of them breaks. And that collision is coming. What happens when a carefully managed narrative runs headfirst into something it can't control? Because that's exactly where this story turns from quiet pressure into open conflict. Up until now, everything could still be framed, explained away, softened. There was always a talking point, a reframing, a reminder that this is all part of the plan. But real estate listings don't listen to talking points. They don't care about intention. They don't care about messaging. They don't care about timing that works better for a brand refresh. They just sit there, public, searchable, time-stamped. And once that happens, you're no longer managing a story. You're fighting a fact. Let me ask you something. Have you ever noticed how PR works best when there's ambiguity? When details are fuzzy, when timelines are flexible, when motivations can be interpreted multiple ways. A listing destroys that ambiguity. It creates a fixed reference point, a before and after. And that's why this moment mattered so much more than people realized. Because the second that property hit the market, a silent war began. On one side, the narrative. On the other, the data. And those two were no longer aligned. Here's how optics usually work in situations like this. You seed an alternative explanation early. You give friendly outlets a soft rationale. You let commentators frame it as intentional, strategic, empowering, streamlining, refocusing, new chapter. All harmless words. All effective when there's nothing concrete to contradict them. But listings are concrete. They have dates. They have prices. They have photos. They have reductions if things don't move. And people who understand money know exactly how to read them. This is where the optics war began to slip out of control. Because while public-facing messaging tried to emphasize choice, insiders were reading urgency. Choice looks relaxed. Urgency looks priced to move. And the price told a story that words couldn't rewrite. Now let's talk about timing again, because timing is everything in optics. If this were purely strategic, it would have been rolled out with context. Controlled leaks, framing interviews, a broader narrative about relocation, reinvention, or investment reshuffling. Instead, it landed with a thud. No build-up, no commentary, no clarification, just a listing. And silence. Silence can be powerful when you're in control. But silence becomes dangerous when others are filling the gaps for you. And that's exactly what started happening. Speculation didn't come from tabloids first. It came from real estate watchers, industry analysts, people who monitor high-end markets as a profession. They asked practical questions. Why now? Why this price? Why public instead of off-market? Those questions weren't emotional. They were technical. And technical questions are hard to deflect with emotion. Now imagine being inside the PR operation at this moment. You're watching headlines form without your input. You're seeing social media connect dots you didn't want connected. You're realizing that the house, the very symbol you leaned on, is now undermining your message. That's when spin turns defensive. Because once you're reacting instead of leading, you've already lost ground. Here's the contradiction that made this especially brutal. The narrative required strength, stability, control. The listings suggested transition, pressure, adjustment. Those two things cannot coexist comfortably. So the messaging had to walk a tightrope. Acknowledge movement without admitting necessity. Frame change without implying strain. Project confidence without inviting scrutiny. That's almost impossible. Because confidence usually comes from consistency. And consistency was gone. Now let's talk about the audience. Audiences today are savvier than PR teams like to admit. They don't just read headlines. They cross-reference. They compare. They remember what was said 6 months ago. So when the messaging said one thing and the market activity said another, people noticed. And once they notice, trust erodes. This is the part most people underestimate. Optics don't collapse all at once. They fray. A question here. A raised eyebrow there. A skeptical comment that gets more likes than expected. And suddenly, the tone shifts. Instead of admiration, there's curiosity. Instead of curiosity, there's doubt. Instead of doubt, there's speculation. And speculation thrives in silence. Now think about the internal stress this creates. PR teams don't just manage headlines. They manage morale. They're trying to reassure their clients while simultaneously calming external noise. They're telling them, this is fine. We can handle this. But they're also watching engagement metrics change in real time. Sentiment cools. Comments sharpen. Questions get less charitable. And that's exhausting. Because the hardest narratives to manage are the ones that don't come with a villain. There's no scandal here. No single event to blame. Just a series of signals pointing in the same direction. And that direction isn't flattering. So what do? You lean harder on spin. You emphasize intention. You highlight future plans. You redirect attention elsewhere. But here's the fatal flaw. Spin only works when it's supported by evidence. And the evidence, in this case, was working against it. Now let's talk about the listing itself again. Listings have tells, days on market, price adjustments, photo choices, language in the description. People who know how to read them can tell when a sale is exploratory and when it's motivated. And this one read motivated. That doesn't mean desperate. It means purposeful. Purposeful exits don't wait forever. And that's what rattled people. Because a motivated sale suggests a timeline. And timelines imply pressure. Which brings us back to debt, obligations, and sustainability. No amount of PR can erase that implication. You can soften it. You can distract from it. But you can't eliminate it. And once the optics war reaches that stage, it starts bleeding into every other narrative. Past statements get re-examined. Old interviews get replayed with new skepticism. Promises get measured against outcomes. This is how public trust erodes. Not through scandal, but through inconsistency. Now imagine being the person at the center of this. Every move you make is now filtered through doubt. Even positive developments are questioned. Is this real momentum or a distraction? Is this growth or a stopgap? Is this confidence or compensation? That's a brutal place to be. Because the harder you try to control perception, the more obvious the effort becomes. And effort reads as insecurity. Now here's the cruel irony. The sale itself might be the smartest financial move possible. It might reduce exposure. It might simplify obligations. It might create breathing room. But smart financial decisions don't always look good optically in the short term, especially when your brand is built on the appearance of unshakable stability. So the optics war intensifies. PR pushes one narrative. The market pushes another. And the market is undefeated. Because markets don't care about reputations. They respond to conditions. Now let's look at the ripple effects. Once the optics war becomes visible, it affects negotiations elsewhere. Potential partners hesitate. They want more assurances. They structure deals with more safeguards. And safeguards usually mean less favorable terms, which puts more pressure on cash flow, which feeds the very narrative you're trying to avoid. This is how feedback loops form. And once they do, breaking them requires drastic action. Sometimes that action is transparency. Sometimes it's retreat. Sometimes it's reinvention. But all of those options require admitting that something changed. And admission is the one thing this narrative has resisted at every turn. So instead, there's tension. Tension between what's being said and what's being seen. And that tension is now unsustainable. Because the longer it lasts, the more credibility it burns. Now ask yourself this. If the optics war is already this intense at the listing stage, what happens if the house doesn't sell quickly? What happens if there's a price reduction? What happens if days on market stretch? Because each of those scenarios escalates the conflict. Each one hands more ammunition to skeptics. Each one tightens the vice. And that's why the next phase of this story is so critical. Because the optics war can't continue indefinitely. Something has to resolve it. Either the narrative adapts to the reality, or the reality forces the narrative to collapse. And in the next chapter, we're going to look at why that $14 million price tag matters so much more than people realize. Because that number wasn't chosen casually. It was a signal, and signals, when decoded, tell you exactly how much pressure is really in the system. What if the price wasn't about value at all, but about urgency? Because that's the detail most people skim past without realizing how much it reveals. $14 million. On paper, it sounds impressive. It sounds like power, like confidence, like leverage. But numbers don't exist in a vacuum. They exist in context. And in Montecito, context is everything. Let me ask you something right away. When someone truly isn't pressed, do they pick a number that invites negotiation or a number that forces attention? Because $14 million does something very specific. It anchors the conversation. It says, this is serious, this is immediate, and this is not an experiment. That's why this chapter matters more than people think. Because price is language. And this price was speaking loudly. Let's break it down carefully. In a market like Montecito, ultra-high-end properties rarely debut with aggressive round numbers unless the seller has a reason. Truly relaxed sellers test the waters. They float high. They leave room. They whisper availability to the right brokers. They don't plant a flag. A flag is planted when time matters. And time was suddenly very present here. Now, to the average observer, $14 million might look like confidence. A strong opening move. A seller signaling they know what they have. But to people who understand high-end real estate psychology, that number reads differently. It reads as price to move. Not distressed. Motivated. There's a difference. Distressed sellers chase the market downward. Motivated sellers position themselves to exit efficiently. And efficiency becomes the priority when the goal isn't maximizing upside, but minimizing exposure. That's the first clue. Now let's talk about why the number wasn't higher. If this were purely about prestige, ego, or holding power, the ask would have been north of where it landed. Montecito supports that. Comparable properties justify it. The market could have tolerated a bolder opening. So why didn't it happen? Because a higher number invites time. Time on market. Time for scrutiny. Time for speculation. And time was the one thing this situation could no longer afford. Every extra week on the market would have amplified questions. Every price reduction would have screamed urgency. Every delay would have tightened the optics vice we already talked about. So the price had to do two things at once. Look strong. Move fast. That's a narrow target. And $14 million sits right in that corridor. Now think about the emotional layer attached to pricing. Pricing isn't just math. It's psychology. It's how sellers manage anxiety. It's how they project certainty when certainty is thinning. It's how they control a narrative without saying a word. A well-chosen price can calm advisors, reassure partners, and signal decisiveness. And decisiveness was desperately needed here. Because indecision is dangerous when pressure is mounting. Now let's talk about what that number communicates to different audiences. To casual observers, it's just a big number. To real estate professionals, it's a code. It says, this seller wants resolution. To neighbors and insiders, it says, this chapter is closing. To critics, it says, something changed. And to anyone tracking the broader narrative, it says, the clock is ticking. That's why the number mattered. Because numbers tell the truth faster than words. Now let's examine what the price didn't do. It didn't scream luxury excess. It didn't scream arrogance. It didn't scream detachment. It screamed practicality. And practicality is rarely part of celebrity mythology. Celebrities are expected to be indulgent, not efficient. So when efficiency shows up, people notice. That's when curiosity spikes. Because efficiency usually follows pressure. Now let's consider the alternative. What if the house had been listed at $18 million? People would have shrugged. They would have said, testing the market. They would have assumed patience. But $14 million? That forces engagement. It pulls in buyers who were watching but waiting. It moves conversations forward. It compresses timelines. And compressed timelines are always a response to something external. You don't compress unless you have to. Now let's talk about leverage again. Leverage isn't just about money. It's about optionality. The more optionality you have, the less aggressive you need to be. When optionality shrinks, prices sharpen. And something about this situation clearly reduced optionality. The house wasn't just an asset anymore. It was a variable that needed removal. And removal requires a number that works. Not a dream number. A working number. That's the difference between fantasy pricing and strategic pricing. This was strategic. Now think about the ripple effects again. Once that number hit the market, it set expectations. Buyers adjusted. Brokers recalibrated. Observers started counting days. And days matter. Days on market are read like vital signs. Short stays signal confidence. Long stays invite doubt. Which means every day the house remained unsold became another data point. And data points accumulate fast. Now imagine being inside the situation, watching those days tick up. Each day, without movement, adds pressure. Each inquiry that doesn't convert creates tension. Each showing that doesn't lead to an offer raises questions. That's not just financial stress. That's psychological stress. Because once you choose a number like $14 million, you're committing to the idea that the market will respond. If it doesn't, the narrative shifts again. And the next move becomes even harder. Do you adjust the price? Do you wait? Do you pull the listing and risk looking indecisive? Every option carries cost, which is why the initial price had to be right. Not perfect. Right. And right, in this case, meant aligned with urgency. Now let's talk about something subtle but critical. Round numbers in high-end real estate are rarely accidental. They're chosen because they're memorable. They travel well in headlines. They anchor perception. 14 million sticks. It becomes shorthand for the story. And once a number becomes shorthand, it's inseparable from the narrative. People stop talking about the house. They start talking about the $14 million house. And that repetition reinforces the idea that this is a defining moment, not just another transaction. Now consider how that plays into the broader optics war. PR teams can spin motivations. They can frame intention. They can redirect focus. But they can't erase a number that keeps getting repeated. Numbers are stubborn. They don't soften over time. They don't change tone. They don't forget. And $14 million was now baked into the conversation. Every analysis referenced it. Every speculation circled it. Every comparison used it, which meant the house sale could no longer be minimized. It had become central, and centrality is dangerous when you're trying to manage perception. Now here's where this gets even more revealing. The price didn't just communicate urgency to buyers. It communicated something to the people involved behind the scenes. It drew a line. It said, this is the window. If this moves quickly, relief follows. If it doesn't, pressure escalates. That's a high-stakes bet. And people don't make high-stakes bets unless they feel constrained. Now think about what happens once a buyer enters the picture. Offers come with contingencies, inspections, negotiations. Each one opens the door to scrutiny. Each one invites questions. And those questions don't stop at the house. They spill into lifestyle. They spill into finances. They spill into future plans. Which means selling the house is not the end of the story. It's the beginning of the next interrogation. Because once you sell, people want to know what replaces it. Where do you go? How do you adjust? What changes? And those answers will speak louder than any press release. That's why the price matters so much. Because it sets the tempo for everything that follows. Fast sale, controlled transition. Slow sale, extended scrutiny. And scrutiny is the enemy of fragile narratives. Now let's connect this back to the earlier chapters. The pressure cooker. The debt conversation, the thinning Hollywood circle, the optics war, all of it converges here. At a number. A number chosen not for ego, but for outcome. And outcomes, in this case, had to come quickly. Because the longer this dragged on, the more dangerous it became. Not just financially, narratively. Now ask yourself this. If the price was loud, what else was it trying to drown out? What urgency was it masking? What pressure was it absorbing? What countdown was already underway? Because prices don't shout unless there's noise behind them. And that noise is building. Because the moment the price was set, another clock started ticking. The clock that counts what happens if this doesn't resolve cleanly. And in the next chapter, we're going to look at the thing that forced this pricing strategy into existence. The unspoken agreement that quietly collapsed. Because when agreements break down, numbers step in to finish the job. And that breakdown changes everything. What if the most important deal in this entire story was never written down? Because that's where things quietly unraveled. Not with a contract dispute, not with a dramatic confrontation, but with an understanding that stopped working. Every high-level arrangement has two versions, the official one and the real one. The official version is what people say out loud. It's polite, vague, flexible, designed to preserve relationships. The real version is what everyone assumes but never articulates. The timelines. the expectations, the invisible boundaries. And when those two versions drift too far apart, things break. That's what happened here. From the beginning, this wasn't just about housing. It was about transition. The assumption was simple. This is a bridge, not a destination. A bridge implies movement, progress, an endpoint. And as long as everyone believes the crossing is underway, the bridge feels solid. But what happens when the crossing stalls? Let me ask you something directly. Have you ever been part of an arrangement where no one agreed on how long it would last, but everyone pretended they had? That's the danger of unspoken agreements. They work beautifully until they don't. At first, everything aligned. Support,